In February 1895, the United States Treasury's gold reserve had fallen dangerously low. President Grover Cleveland faced a crisis of confidence. If investors concluded that the government could no longer maintain gold payments, the nation's currency system could unravel. The federal government was not formally bankrupt, but its ability to defend the gold standard was under severe doubt. Into that vacuum stepped J. Pierpont Morgan. With August Belmont and international banking connections, he arranged a private syndicate to supply gold to the Treasury in exchange for government bonds. The rescue protected the reserve, but it created a far more unsettling question. Why did the most powerful government in the world need Wall Street to restore confidence in its own money? The 1895 Morgan-Belmont deal became one of the clearest early demonstrations of private finance acting where public institutions could not. 1. A government rich in power, poor in gold. By the early 1890s, the United States was already becoming an industrial giant. Its railroads crossed the continent, its factories supplied expanding cities, and its agricultural exports connected American farms to global markets. Yet behind this image of national strength was a monetary system built on a fragile promise. Many forms of paper currency could be exchanged for gold. The country possessed enormous productive power, but confidence in its money depended on whether the Treasury could honor that promise. For ordinary Americans, paper notes were supposed to function like money because the federal government stood behind them. But the value of those notes was inseparable from public belief. If citizens, banks, or foreign investors began to fear that the government might stop redeeming notes in gold, holding paper became less attractive. The safest response seemed obvious: exchange paper for gold before everyone else tried to do the same. This created a dangerous chain reaction. Each person who redeemed notes for gold did not necessarily intend to cause a crisis. Many simply wanted protection in uncertain times. But collectively, these withdrawals reduced the Treasury's reserve. The lower the reserve fell, the more alarming the situation appeared to the public, and the more people had an incentive to demand gold immediately. The problem became especially severe during the Panic of 1893. Railroad bankruptcies, business failures, unemployment, and collapsing confidence spread across the country. Investors no longer looked only at America's long-term potential. They watched for evidence that the government could defend its currency at that very moment. Gold became more than a metal stored in vaults. It became a measure of whether the United States could still be trusted by global markets. The Treasury had long treated a reserve of roughly $100 million in gold as an essential psychological barrier. It was not simply a legal number that automatically determined whether the government could function. It was a threshold that markets understood. If the reserve fell below it, investors could interpret the decline as proof that Washington was losing control of the currency system. Paper currency made this fear more immediate because it gave holders a direct claim on the Treasury's gold. A note could circulate quietly in a shop, a bank, or a payroll office for years. But in a crisis, that same piece of paper could become a ticket to the Treasury's reserve. When thousands of people and institutions made that choice at once, the government faced a problem no army or tariff could easily solve: a collapse of confidence. Foreign investors added another layer of pressure. European banks and bondholders held American securities and watched the exchange rate closely. If they suspected that the United States might abandon the gold standard, they could sell American assets, demand payment in gold, or move capital elsewhere. Their decisions could drain gold from the country precisely when Washington needed it most. The government attempted to replenish the reserve through bond sales, but the solution was incomplete. New gold could enter the Treasury, only to leave again when note holders redeemed currency. The same weakness returned because the issue was not merely the quantity of gold available. It was the public belief that the reserve would remain secure even during panic. This was the contradiction at the center of the crisis. The United States had land, industry, people, taxation power, and growing global influence. But without a central bank capable of acting quickly as a lender of last resort, it could still be trapped by a run on its own gold. That vulnerability opened the door for J.P. Morgan's syndicate, not because Wall Street had replaced the government, but because it possessed the international financial connections Washington urgently needed. 2. The $100 million line that could not be crossed. The United States Treasury did not operate under a modern central bank system in the 1890s. It had no Federal Reserve to create emergency liquidity, stabilize commercial banks, or calm financial markets during a panic. Instead, much of the nation's monetary credibility rested on the gold held in federal vaults. As long as people believed the Treasury could exchange paper notes for gold, the system appeared stable. The figure most closely watched was $100 million. This amount was widely treated as the minimum gold reserve needed to support confidence in the government's ability to maintain gold payments. Falling below it did not automatically mean national bankruptcy, but it carried a powerful message. The Treasury might no longer be able to defend the dollar if pressure intensified. Treasury notes made the situation more fragile. Under the rules created after the Civil War, holders of certain government notes could present them for redemption in gold. In normal times, this right did not cause major problems. Most people used notes as convenient money, while gold remained largely in the background. During a crisis, however, the right of redemption became a direct path from public fear to the Treasury vault. A merchant worried about the future could convert paper into gold. A bank facing nervous depositors could do the same. Foreign investors, concerned that the United States might weaken its currency or abandon the gold standard, could sell American assets and demand payment in gold. Every individual decision could appear rational, but together they placed the entire monetary system under pressure. This created what economists would later recognize as a self-reinforcing run. Gold left the Treasury because people feared the reserve was shrinking. The reserve then shrank further, giving more people a reason to fear that gold would soon become unavailable. The crisis was driven not only by the physical supply of gold, but by the expectation that other people would demand it first. By early 1895, the Treasury's reserve had fallen dramatically below the symbolic $100 million level. The decline was watched closely by newspapers, bankers, politicians, and overseas financial centers. The number became a daily test of national credibility. A great industrial republic was now being judged by the amount of gold remaining in a government vault. President Grover Cleveland's administration tried to respond through bond sales. The Treasury issued bonds, received gold in return, and temporarily restored the reserve. Yet the strategy did not remove the underlying problem. Once the new gold entered the vaults, it could still be redeemed by holders of Treasury notes, allowing the same cycle of fear and withdrawal to begin again. The political conflict over silver made matters even more complicated. Supporters of silver-backed money believed that the gold standard gave too much power to creditors and financial centers. Supporters of gold argued that abandoning it would damage American credit and drive away foreign investment. The reserve crisis therefore became part of a much larger battle over who should control money and whose interests the currency should serve. By February 1895, the $100 million line had become impossible for Washington to ignore. The reserve had fallen to roughly $41 million, and another failed attempt to rebuild it could have made the government appear even weaker. Cleveland needed more than gold. He needed a plan that would convince markets the outflow had been stopped. That need would bring the Treasury to J.P. Morgan and the private financial network that could reach gold markets beyond America's borders. 3. Cleveland's search for a way out. President Grover Cleveland entered the crisis with a firm belief that the United States had to remain on the gold standard. To him, gold was not simply a monetary preference. It was the foundation of national credit. If the government allowed doubts to spread about the dollar's value, he feared that foreign investment would retreat, borrowing costs would rise, and the economic depression would deepen. Congress did not share one unified answer. Many lawmakers, especially from farming regions in the South and West, believed the gold standard had already concentrated too much power in the hands of Eastern banks, creditors, and wealthy bondholders. They favored expanding the money supply through silver, arguing that a larger volume of currency could ease debt burdens and revive economic activity. The disagreement was not only ideological, it was also political. Cleveland was a Democrat, but his commitment to gold placed him against influential figures within his own party. Congressional Democrats increasingly faced pressure from voters who associated the Depression with Wall Street, railroad corporations, bank failures, and a monetary system that seemed designed to protect financial elites. Cleveland had already seen how difficult it was to govern during this division. In 1893, he had pushed Congress to repeal the Sherman Silver Purchase Act, which required the federal government to buy large quantities of silver. He believed the policy encouraged people to redeem government paper for gold, accelerating the drain on the Treasury Reserve. The repeal succeeded, but it did not end the crisis. By 1895, each proposed solution brought political danger. Asking Congress for stronger authority could lead to delay, public debate, and demands for silver legislation that Cleveland rejected. Issuing more bonds could replenish the Treasury temporarily, but it also made the administration look dependent on investors. Doing nothing, however, risked a deeper loss of confidence in the government itself. The conflict became especially intense because the crisis revealed two competing views of democracy. One side argued that elected institutions should decide the future of the currency, even if that meant challenging the existing gold system. The other argued that confidence in financial markets was too important to place at the mercy of political negotiation. Cleveland increasingly treated the defense of gold as an emergency that could not wait for a divided Congress. The administration had another problem. Previous bond sales had not produced a lasting solution. Gold entered the Treasury, but holders of redeemable notes could still demand it again. Congress could criticize the president for issuing bonds, but it offered no quick and unified plan to stop the recurring outflow. Washington was trapped between political disagreement and financial urgency. Cleveland's advisors began searching for legal powers that could be used without waiting for new legislation. They found support in an older law that allowed the government to issue bonds to obtain coin when necessary. This authority gave the administration a possible route forward, but it did not solve the practical question of where to find enough gold, or how to stop it from immediately leaving the country again. That was why the White House turned toward J.P. Morgan. The decision was deeply controversial because it seemed to confirm what Cleveland's critics had feared. When Congress could not act and the Treasury could not stabilize the reserve, a private banking network could become essential to national policy. The coming agreement would protect the gold reserve, but it would also expose the divide between democratic authority in Washington and financial power on Wall Street. 4. Morgan's offer: gold, bonds, and control. J.P. Morgan did not arrive at the Treasury crisis as an ordinary banker with a large amount of cash. By 1895, he stood at the center of a transatlantic financial network built through railroad financing, corporate reorganizations, investment houses, and long-standing relationships with banks in London, Paris, and New York. That network gave him access not only to capital, but to information, trust, and international gold flows. Morgan understood that the Treasury's problem was larger than finding a shipment of gold. Previous bond sales had already shown that fresh gold could enter federal vaults and then leave again through renewed redemptions. What Washington needed was a deal that could replenish the reserve, while also convincing markets that future withdrawals would be contained. In other words, the crisis had to be solved in public perception as well as in metal. The opportunity emerged when Morgan and his associate August Belmont met with the Cleveland administration. Belmont represented interests connected to the Rothschild banking network, one of Europe's most influential financial families. Together, Morgan and Belmont could link the American treasury to foreign sources of gold and to investors who trusted their ability to coordinate a large international transaction. Their proposal was straightforward in appearance, but sophisticated in practice. A private syndicate would purchase United States government bonds and pay the Treasury in gold. The government would receive the reserves it urgently needed, while the bankers would obtain long-term bonds that could later be sold to investors. Yet the agreement also required far more than a simple exchange between buyer and seller. Morgan's network could organize the movement of gold from Europe to the United States. It could recruit investment firms to participate in the bond purchase. It could communicate with banks and foreign exchange houses that influenced whether gold would remain in the country or be exported again. The deal, therefore, joined government borrowing, international banking, exchange rate management, and market confidence into one coordinated operation. This was where Morgan's real influence became visible. A national emergency had created a problem that the government could not easily solve through politics alone. Morgan transformed it into a financial contract with defined terms, trusted intermediaries, and a network able to carry out the plan quickly. The Treasury supplied the government bonds. Morgan supplied the organization that could turn those bonds into gold and reassurance. The agreement also revealed the limits of federal power at the time. The government could issue currency and collect taxes, but it lacked a central bank and a permanent mechanism for coordinating emergency credit. Morgan's syndicate could move faster because it operated through private relationships rather than public debate. That speed made the rescue possible, but it also made the transaction politically explosive. Critics believed the bankers had gained extraordinary leverage. In their view, Morgan was not merely helping the government. He was negotiating from a position created by the government's weakness. The fact that the Treasury needed private financiers to protect its gold reserve appeared to confirm fears that Wall Street could influence national policy without facing the same democratic accountability as elected officials. Morgan's defenders saw the matter differently. They argued that the syndicate was taking a genuine risk at a moment when confidence in American securities was fragile. If the rescue failed, the bankers' reputation and capital would also be exposed. From this perspective, the deal was not a private takeover of government, but an emergency partnership between public authority and financial expertise. Still, the terms of the arrangement left a lasting impression. Morgan had shown that control over international credit, gold markets, and investor confidence could be as important as formal political office during a financial panic. The Treasury would receive the gold it needed, but the price was unmistakable. Wall Street had demonstrated that it could negotiate with Washington not as a subordinate, but as an indispensable power. 5. The deal that refilled the Treasury. On February 8, 1895, the Cleveland administration reached an agreement with the Morgan-Belmont Syndicate. The group promised to provide the United States Treasury with approximately $65 million in gold in exchange for 30-year government bonds. It was one of the most consequential private financial agreements in American history because it placed the defense of the nation's currency in the hands of a group of bankers. The amount mattered, but the source of the gold mattered just as much. A large part of the rescue depended on Morgan's ability to obtain gold through European financial markets. American banks alone could not guarantee a rapid and lasting supply. Morgan's connections in London and Paris made it possible to reach reserves held beyond the immediate pressure of the American panic. European gold gave the arrangement international credibility. Investors did not see the deal merely as Washington borrowing from local banks in New York. They saw major financial houses on both sides of the Atlantic committing their capital and reputation to the survival of American credit. That signal helped reduce the fear that the United States would abandon the gold standard. August Belmont played a critical role in this international dimension. As the American representative of interests linked to the Rothschild network, he helped connect the Treasury Agreement to European investors and gold markets. Morgan brought authority on Wall Street, while Belmont strengthened the syndicate's access to the financial centers that still dominated global lending. The Treasury received the gold it urgently needed, but the syndicate also attempted to address the deeper problem: continued gold outflows. Its members worked through foreign exchange markets and banking relationships to reduce incentives for exporting gold from the United States. The aim was not simply to fill the vault once, it was to stop the reserve from immediately draining again. This was why the agreement restored confidence more effectively than earlier bond issues. Previous sales had brought gold into the Treasury, but they hadn't convinced markets that the outflow was under control. Morgan's syndicate offered a broader solution: new gold, international coordination, and a public commitment by powerful financiers to support the reserve. The bond sale also gave the government time. Instead of facing an immediate collapse in confidence, the Cleveland administration could show that the Treasury had regained a substantial supply of gold. The reserve rose above the level that investors considered dangerously low, and the fear of an imminent break with the gold standard began to weaken. Yet the deal was never politically neutral. Americans soon learned that the government had sold bonds directly to a private syndicate, rather than opening the entire transaction to broader public competition. Critics argued that Morgan and his partners had received favorable terms because Washington had negotiated under pressure. To them, the rescue looked less like a national victory and more like proof that financial elites profited when public institutions became desperate. Supporters of the agreement answered that the country had faced an emergency, not an ordinary bond sale. Morgan's network had brought European gold into a moment of extreme uncertainty and helped prevent another rush against the Treasury. Whatever the political cost, the deal succeeded in its immediate objective. It stabilized the gold reserve and showed that American credit still had powerful defenders. 6. Was it a rescue or a private takeover of public power? The Morgan-Belmont Agreement solved the Treasury's immediate crisis, but it created a political crisis of its own. Americans had watched the nation's gold reserve fall to dangerous levels, and now they learned that the recovery depended on a private syndicate led by J.P. Morgan. The deal raised a question that went far beyond the price of bonds. Had Wall Street rescued the government, or had the government revealed how dependent it was on Wall Street? The terms of the agreement quickly became controversial. The syndicate agreed to buy government bonds at a set price and then sell them to investors. Because the bonds could be resold at a higher market price, Morgan, Belmont, and their partners had an opportunity to earn substantial profits. Critics saw those profits as the reward for possessing influence at the exact moment the country had no alternative. Supporters of the deal argued that profit was not proof of exploitation. The syndicate had accepted risk by committing itself to a large purchase when the nation's financial future remained uncertain. It also had to organize gold shipments, work through foreign exchange markets, and persuade investors that American bonds were worth buying. From this view, the bankers earned compensation for solving a difficult international financial problem. But the political atmosphere of the 1890s made that defense difficult to accept. The country was still suffering from unemployment, business failures, falling farm prices, and widespread anger toward corporations. Many citizens believed that banks and railroads had gained enormous influence, while ordinary workers and farmers carried the cost of the Depression. The Morgan deal appeared to place that imbalance in full view. Newspapers and political opponents attacked the administration for negotiating privately with financial elites. They argued that the bonds should have been offered openly to the public, allowing a wider range of buyers to participate. Instead, the government had dealt directly with a group of powerful firms that already possessed the capital, information, and international connections needed to benefit from the crisis. The controversy damaged President Cleveland's standing inside his own party. Gold Democrats defended the agreement as a painful but necessary measure to preserve national credit. Silver supporters, populists, and many Western Democrats viewed it as evidence that the administration cared more about bankers and bondholders than about the people suffering from the Depression. The backlash also strengthened the political movement against the gold standard. To critics, the reserve crisis proved that a monetary system tied to gold gave private financiers too much influence over the country's future. If Wall Street could determine whether the Treasury remained solvent, then money itself seemed to be controlled by institutions beyond democratic reach. Morgan became a powerful symbol in this debate. He was not personally responsible for every weakness in the American financial system, and he did not literally control the federal government. Yet he represented something larger: the ability of a small financial network to mobilize capital across borders faster than elected officials could build a public response. The bond sale therefore left behind two competing interpretations. One was that Morgan's syndicate prevented a deeper monetary disaster when Washington had few workable choices. The other was that the crisis exposed a dangerous reality. Private banks could profit from government weakness while gaining influence over decisions that affected the entire nation. That tension would not disappear after 1895. It would help shape the demand for a central bank and a new financial order in the decades ahead. 7. From the gold crisis to the Federal Reserve. The 1895 gold crisis had revealed a structural weakness in the American financial system, but it did not create a permanent solution. The Treasury Reserve was stabilized, the gold standard survived, and confidence slowly returned. Yet the central problem remained. The United States still had no institution designed to provide emergency liquidity when banks, investors, and depositors lost confidence at the same time. 12 years later, the panic of 1907 exposed that weakness again on an even larger scale. The immediate trigger came from a failed attempt to manipulate the stock of the United Copper Company. When the scheme collapsed, suspicion spread toward the banks and trust companies connected to the financiers involved. What began as a failed speculation quickly became a wider crisis of trust. Depositors rushed to withdraw money from the Knickerbocker Trust Company, one of New York's largest trust companies. Unlike commercial banks, trust companies often operated with lower cash reserves and fewer restrictions. Once people feared that a major institution might fail, the problem spread beyond Knickerbocker itself. Depositors began questioning whether other financial institutions had enough cash to meet withdrawals. The panic moved through New York's financial system with alarming speed. Banks became reluctant to lend to one another, stock prices fell, and companies found it harder to obtain short-term credit. Since New York was the center of the country's financial network, stress in the city affected businesses, banks, and communities far beyond Wall Street. Once again, the federal government lacked an effective mechanism to act as a lender of last resort. The Treasury could deposit funds in banks, but it could not coordinate the financial system with the speed or authority required. There was still no central bank able to identify vulnerable institutions, provide emergency credit, and prevent fear from turning into a national banking collapse. J.P. Morgan again became one of the central figures in the response. By 1907, his reputation was even greater than it had been during the gold crisis. He brought together bankers, trust company leaders, railroad executives, and government officials in an effort to decide which institutions could be saved and which could be allowed to fail. Morgan's role was not simply to provide his own money. He acted as a private coordinator of capital. He pressured rival bankers to contribute funds, examined the finances of troubled institutions, and helped organize rescue plans. His ability to make decisions quickly was valuable in an emergency, but it also meant that an unelected private banker had enormous influence over the survival of major American companies. The panic of 1907 convinced many Americans that this arrangement could not continue indefinitely. The country had become too large, too industrialized, and too dependent on complex financial markets to rely on one financier's relationships and judgment. Even those who admired Morgan understood that a nation could not build permanent stability around the health, reputation, and personal authority of a single man. The result was a growing movement for institutional reform. After years of investigation and debate, Congress created the Federal Reserve System in 1913. The new central bank was designed to provide liquidity during crises, supervise parts of the banking system, and reduce the need for private financiers to act as emergency guardians of the national economy. Morgan's rescues had demonstrated Wall Street's extraordinary power, but the Federal Reserve was created so that, in the next panic, the survival of the financial system would not depend on Wall Street alone.